if you see a fire coming towards your house, good luck getting fire insurance, right? It's the same now, I think, as more and more people wake up to what's the currency crisis that I believe is coming, more and more people are going to want physical, and there's just not enough. And we saw just back in February on the first silver squeeze push, I mean, the delays and the premiums were pretty exorbitant. And I think that's an early trend. Like this is a trend that's only going to accelerate as time goes on. And if you want to go to like an extreme example, like take a look at Venezuela. Imagine how many people there would like to walk down to the coin shop and swap some paper fiat currency for silver. Like it's not going to happen. So that's kind of an extreme example. And I think we are headed in that direction. I'm not saying we go that far, but that's the direction we're headed. Yeah, I started here. Here I've got a 1-year chart for the US dollar, actually just over a year. It goes back to March of 2020. And really the big thing that jumps out here is the series of lower highs and lower lows dating back to March of 2020. And we see price trading below a declining 50 and 200-day moving average. So the dollar is in a downtrend no matter how you measure it. And the institutional trading algorithms that really drive most of these markets, they tend to be in a sell the rally mode when price is in a downtrend, especially below those key moving averages. So the path of least resistance for the dollar is lower. However, we do have that support right there at 89.21. And then there's the 2018 low of 88.25 that's not on this chart. But I think once that 88.25 level is cleared to the downside, the trend could accelerate to the downside in the dollar. And of course, that would be just another headwind for the metals and commodities in general. Typically, when you have a trend reversal in the precious metals sector, what I look for is for the senior gold miners to lead the reversal, right? Because that's where the institutions and big money investors go first. They want those senior gold miners. Well, that's exactly what we saw here in GDX. GDX broke out last month. These are monthly candlesticks. We broke out, came back and back tested it, and then rallied strongly in the month of May. We're speaking here on the last day of the month of May. So this is a monthly close above this breakout level. So that's very bullish here in GDX. So the path of least resistance is going to be higher highs and higher lows going forward. But of course, nothing goes straight up. But I do believe that the trend has changed. And when we look at some other charts, it kind of confirms and validates that trend reversal in the sector. Yeah, so in my mind, I mentally kind of break the whole precious metals sector down into 6 subcomponents. So you would have the physical metals, that's 2, the senior gold miners, senior silver miners, junior silver miners, and senior silver miners. I think I said that correctly. So you got those 6 components, and I look at ratios between the 2 or between all 6 to see what's the most undervalued at any given moment. And right now, I think it's junior silver miners have the most compelling asymmetric setup if you have an intermediate to long-term time frame.
And why is that, Steve?
I think it's just investor psychology. The big money comes into the more senior sectors first, and then this more speculative components of the sector tend to follow suit and then outperform. Like, for example, we saw back in 2019, gold broke out first, and then silver follows because it's more speculative. And I think that's what's going to happen going forward. The silver miners, junior silver miners should continue their breakout and outperform going forward. However, a lot of people, I think, conflate volatility with risk. I wouldn't necessarily put it that way. I think junior silver miners or silver in general is, I think, less risky than gold because of the gold silver ratio if you have a long-term time frame and you can stomach the volatility. But yeah, that's a good point. Junior silver miners are much more volatile. Yeah, so like the ETF SILJ, a lot of people will correctly point out that they're really not junior mining stocks in SILJ. They're more like mid-cap and mid-tiers. But I think a more speculative basket will outperform at the expense of perhaps a little bit more risk. But the more junior stocks should really outperform an ETF. But, there's nothing wrong with owning the ETF. Some people are, they just don't have the time to allocate to learning the sector. They don't have time to do their due diligence on individual stocks. So there's nothing wrong with the ETF from my perspective. Okay, so we saw GDX. You can see it's confirmed its breakout, right? Mm-hmm. So now we see GDXJ kind of following suit. It's just lagging behind a little bit, which is typical. The more speculative components kind of lag. So this is a nice breakout here on the monthly candle. And then when you look at SILJ, even more speculative component of the sector, look, it's just beginning to poke its head above this downtrend line that goes back to 2013. So I'm looking for SILJ to now confirm a breakout. And then we'd have really a breakout across the whole sector. The only one we're waiting on is physical silver. The last couple charts here for precious metals, I just have a gold chart and a silver chart. And this is textbook right here, textbook technical analysis of gold, where you can see this big cup and handle pattern. I mean, this is very obvious to anyone who looks at charts, I should say, which means it's obvious to the institutional trading algorithms that really drive these markets. And so you see this big cup pattern here, and here's the handle. And then what typically happens, once you get a breakout above the upper rail of this little downtrend channel here, the immediate target becomes the top of this flagpole, so $2,089. Now, that doesn't mean we're going to go like straight there in the next few days, but that's the intermediate term target. And I think once we get above that level, the uptrend could really accelerate in gold. And then I also have a chart for silver here. And like I said, silver is the only one that really hasn't confirmed a breakout yet. For me, that's $30.35. You could call it $30, but I like to be more conservative. And we did have that one wick on February 1st that went up to $30.35. So that's the level I'm looking for a breakout. And once we get that, I think $50 silver could probably happen faster than a lot of people think. I'm not saying it happens like in days or weeks after, but I think within a few months is totally reasonable for silver to hit 50 once that $30 level is cleared. I believe silver is manipulated, and I think it's probably the most manipulated commodity on the planet. However, I don't think they can manipulate the overall long-term trend, but they do manipulate, on a daily, in short time frames. So I think Craig Hemke, who you've had on the show many times, I consider him a mentor. He calls it manipulation analysis. And if you kind of know the inputs into these banking trading algorithms, you can kind of predict when they're going to smash the price or when they're going to, you can it gives you an edge to identify inflection points. So like, for example, if you're coming up to a major resistance level and you're technically stretched, the RSI is above 70, and you look at that commitment of traders report and you see the commercial banks are heavily short, there's a really good chance that, they're going to come smack the price in the paper market and see a sharp, a little drop downwards. So that's kind of how I think about it. Price and volume overlaid on a chart, to me, is the most information dense source of market information out there. So it's literally telling you what's happened. And when it comes to manipulation, that's where I don't listen to what these bankers and Wall Street people say. I watch what they do. And when it comes to a price chart, they can't cover their tracks. Price and volume is going to leave tracks on the chart. So you can kind of see what the institutions and the big money is doing, to include the manipulators. Commodities are ridiculously undervalued relative to the S&P 500. And what's interesting is when things like this turn, they typically don't just revert to the mean. When something's so far out of whack, it typically overshoots the mean and goes to the opposite side. So if and when this turns around, which I think is happening right now, I think we're going to see a multi-decade commodity bull market that is, I don't want to say unprecedented to sound dramatic, but I think a lot of money is going to be made in the next commodity bull market. And I think we're in the early stages of that. In 1980, we had just finished a big commodity bull market and stocks had bottomed. So that's why that's a key inflection point right there.